In this video, we're going to focus on fundamental analysis, how to determine if a company is undervalued or if it's overvalued. What we're going to do today is we're going to take a look at a lot of different valuation ratios that you could use to determine if a company is undervalued or overvalued. Valuation ratios such as the price to sales ratio, price to earnings, the price to book ratio. We'll also consider some other ratios that help you determine the health of a company, such as liquidity ratios like the current ratio, the quick ratio, debt to equity ratio, and things like that. So let's go ahead and begin with this video. So the first thing you need to know is market capitalization. Market capitalization tells you the value of a company. It's the product of the shares outstanding times the share price. So let's say if a company has 100 million shares that are being traded. These include restricted shares as well. And let's say the price of each of those shares is $5. So the market capitalization of that company would be $500 million. Now, in order to calculate the price to sales ratio, you need to take the market cap and divide it by the number of sales. And here's what you need to know. If the price to sales ratio is very low, let's say less than 1, typically that indicates that a company may be undervalued with reference to its sales. If the price to sales ratio is significantly larger than 1, then that's an indication that it could be overvalued. Now let's look at an example. Let's say we have company A and company B. So we're going to consider the market cap of each company, and let's say the market capitalization is the same. Both companies A and B have a market cap of $100 million. Now, let's talk about the sales of each company. Let's say company A generated 50 million in annual sales, and company B generated 200 million in annual sales. So, what will the price to sales ratio be for each of these two companies? Using the equation that we have here, the price to sales ratio will be the market cap divided by the sales. 100 divided by 50 is 2. 100 divided by 200 is 0.5 or half. So notice the difference between the price to sales ratio of company A and company B. Both companies have the same market cap, but which one would you say has a higher value? Company A or B? Now, company B is more valuable than company A because the sales that it's generating is higher than that of A. So because the sales are higher, notice that the price to sales ratio is lower. So company B is undervalued with respect to company A. Thus, when the price to sales ratio is low, this is an indication that the company might be undervalued. Now let's analyze this from another perspective. So this time, let's say we have 3 different companies: company A, company B, and company C. We're going to look at the market cap of each company, the price to sales ratio, and the sales of each of those 3 companies. So in this example, let's assume that the market capitalization for each company is the same. We're going to go with 1 billion. Now the price to sales ratio is going to be different for each company. So for company A, the price to sales ratio is going to be 0.10. For B, it's going to be 1, and for C, it's going to be 10. When the price to sales ratio is 1, that means that the market capitalization and the sales are equal to each other. So the sales for company B is 1 billion. When the price to sales ratio is low, let's say 0.1, if it's less than 1, that means that the sales is greater than the market cap. So if you were to take the market cap divided by the price of sales, it will give you the sales of the company. So company A is generating 10 billion in sales. Now for company C, the price to sales ratio is high. that means that the market cap exceeds the sales. So this is going to be 1 billion divided by 10, which is 100 million. So which of these three companies appear to be more valuable to you? Company A, B, or C, given that they have the same market capitalization? Clearly, the answer is Company A. Assuming that everything else is equal, Company A is generating the highest sales. 10 billion versus 1 billion or 500 million. This is significantly larger. All because the price to sales ratio is the smallest of the three. So keep that in mind. That's one way in which you can determine if a company might be undervalued, is by comparing its sales to its market cap. If the price to sales ratio is very low, then it could be undervalued. If it's very high, that's an indication that it might be overvalued. So there's two important things that can affect the price to sales ratio. As you already know, the sales that the company generates, but also the share price or the price of the stock. As the sales increases, the price to sales ratio decreases. But as the price of the stock increases, the market capitalization increases, given that the shares outstanding remains the same. And as the market cap goes up, the price to sales ratio goes up. So a company could decrease its price to sales ratio by either increasing the sales generated by the company or decreasing the price of the stock, which really depends on market conditions. If the price of the stock goes down, then that's an indication that the company might be becoming undervalued. If the price of the stock goes up, the price to sales ratio goes up, which indicates that a company might be becoming overvalued. Another valuation ratio that is actually quite popular is the price to earnings ratio, or the PE ratio. There's two ways in which you can calculate it. The first method is to take the market capitalization and divide it by the earnings or the net income of a company. You can also calculate it by taking the share price or the price of the stock and dividing it by the EPS or the earnings per share. So like the price to sales ratio, a low PE ratio indicates that the company might be undervalued with respect to companies in that same industry, whereas a high PE ratio indicate that the company might be overvalued, or it may also indicate that investors are really willing to pay a lot of money for the stock, which could indicate that it might go even higher. But nevertheless, a low PE ratio indicates that the company could be undervalued. Now let's use a familiar example to illustrate how the price to earnings ratio can be used to indicate if a company might be undervalued with respect to another company. So in the first row, we're going to have the share price of each company. So let's say the stock for company A is selling at $50. And let's say for company B, it's the same price. Now the EPS, or the earnings per share, we're going to say that for company A, it's $10. So it's earning $10 per share. And for company B, the earnings is $5 per share. Now let's calculate the PE ratio for each of these two companies using this formula. So it's going to be the share price divided by the EPS. So for company A, 50 divided by 10 is 5. For company B, 50 divided by 5 is 10. So now we have the PE ratio of company A and company B. Now looking at these two companies, given that they have the same share price, which one appears to be more valuable to you? Clearly, it's the company that is earning more money. Company A is earning $10 per share, whereas company B is earning $5 per share. So company A is more valuable. And this is indicated by the fact that it has a lower PE ratio of 5 versus a PE ratio of 10. So the lesson here is clear. Just like the price to sales ratio, a low PE ratio indicates that the company might be undervalued with respect to another company in the same industry, whereas a high PE ratio indicates that the company might be overvalued. Now let's spend a moment talking about the EPS, or the earnings per share. The EPS can be calculated by taking the earnings or the net income and dividing it by the shares outstanding. Now, a company with a positive EPS value, this indicates that the company is profitable, that it's making money and it's not losing money. Not all companies have a positive EPS value. So if you were to see a company with a negative EPS value, then this indicates that the company is not profitable. This means that the expenses for that quarter exceeds the revenue. So even though they're making sales, they're spending a lot more money. So imagine if you generated $2,000 for that week, working a job or something, but your expenses that week is $2,500. This is not a good scenario. That means that you're down $500 that week, so your earnings is negative. When the EPS is negative, this means that the company's expenses exceeded their revenue or their sales for that quarter. So a positive EPS is a good sign that indicates that the company is making money, but a negative EPS means that it's losing money. Now, the third valuation ratio that we're going to look at is the price to book ratio. There's two ways in which you can calculate the PB ratio. You can take the market value of the company, that is the market capitalization, and divide it by the book value, or you could take the share price and divide it by the book value per share. So in both ways you can calculate the PB ratio. Now, like all the other valuation ratios, the PS ratio and the PE ratio, a low PB ratio indicates that the company might be undervalued, whereas a high PB ratio indicates that the company may be overvalued. Now, the book value is the difference between the tangible assets and the total liabilities. The tangible assets is the difference between the total assets and the intangible assets. The intangible assets would include patents and things that you can't necessarily put a monetary value on. So the book value is the difference between the tangible assets and the total liabilities. Now, if the book value is equal to a positive number, that's good, because that means that the tangible assets exceed the total liabilities. If the book value is negative, that's not good. That means that the company is in a lot of debt. That means that the total liabilities exceed the total assets. So a positive book value number is good, but a negative book value number is not good. The same is true with the book value per share. If the book value per share is positive, then the book value will also be positive, and that's a good thing. If the book value is negative, then the book value per share is negative. Some websites like FinViz and other stock screeners, they may show the book value per share as opposed to the book value. So it's important to be familiar with both of those terms. Now let's analyze three companies: Company A, B, and Company C. So let's say that the book value per share for companies A, B, and C is $50. Let's say it's the same for each of these three companies. And now let's say that the price per share is $21 for Company A, $51 for Company B, and $96 for Company C. Now let's calculate the PB ratio using this formula. So it's the price of the stock divided by the book value per share. So for Company A, it's 21 divided by 50. Thus the PB ratio is 42 cents for that company. For B, it's going to be 51 divided by 50, which is $1.02. And for C, it's 96 over 50. Well, technically, there really shouldn't be a dollar symbol. It should just be a number, since it's simply a ratio. And for C, it's going to be 1.92. Now, for Company B, the value is pretty much fair. The price to book ratio is about 1, which means that the market value of the company and the book value is almost the same. For company A, this indicates that the company is undervalued. Because the PB ratio is low, that means that the book value exceeds the market cap or the market value of the company. Now for company C, this indicates that it's relatively overvalued. That means that the market value of the company is greater than the book value. So this is just one of the many ratios that you can use to determine if a company might be undervalued or overvalued. Thus, when conducting fundamental analysis, it's good to look at multiple valuation ratios as opposed to just one. This will help you to get the overall picture of the health of the company. So it's good to consider not only the price to earnings ratio, but the price to sales ratio and also the price to book ratio. Another thing you want to consider is the price to cash ratio, which is another indication. It's a less commonly used valuation ratio. But you want to make sure that a business have enough cash to pay off its bills, because if it doesn't, that's not good. Sometimes revenues could change. In a down market, a business revenue can go down. So looking at how much cash a business have on its balance sheet, it should be part of your fundamental analysis when analyzing companies too. So don't forget to research price to cash and the cash per share ratio. A good way to determine or to get a quick estimate of how much cash a company may have, you can multiply the cash per share ratio by the total number of shares outstanding that they have. And this will give you an approximation of how much cash they have on hand on their balance sheets to pay bills and expenses and salaries of their employees and other things like that. Now the next thing that we're going to talk about is a profitability ratio as opposed to a valuation ratio. And this is the profit margin. The profit margin tells you how profitable a company is. It tells you how efficient it can convert sales or revenue into net income. A company that can keep its costs down is one that has a high profit margin. And let's analyze two different companies to illustrate this. So let's use our favorite companies, company A and B. Let's say that the sales of each company are the same. We're going to say that the sales are 200 million for both companies. Next, we have the expenses. Let's say that the expenses for company A is 100 million and the expenses for company B is 150 million. The net income is the difference between the sales or the revenue of the company minus the expenses. So to calculate the net income for company A, it's going to be the difference between these two numbers, 200 minus 100 million. So that's 100 million. And for company B, it's 200 minus 150. That's going to be 50. Next, we can calculate the profit margin. So taking the net income, dividing it by the sales, and multiplying that by 100%, 100 divided by 200 is 0.5 times 100%. This gives us a profit margin of 50% for company A. For company B, it's 50 divided by 200, which is 0.25 times 100%. So company B has a profit margin of 25%. So looking at these two companies, which one is more efficient? Clearly, it's going to be company A. Even though the sales of company A and B are the same, company A has a higher net income and therefore a higher profit margin. 50% of the sales was converted to earnings, whereas in company B, 25% of the sales was converted to earnings. And so the profit margin tells you how efficient a company is in converting sales into earnings or net income. And also notice that company A, they kept their expenses lower than company B. And that's what made them more efficient. By keeping costs down, they were able to generate a higher net income and thus increase the profit margin. So that's how you can increase the profit margin in a company. You need to reduce the costs or the expenses, and as you do so, the net income increases and the profit margin increases. Note that if you increase the sales of a company but don't increase the net income, the profit margin actually goes down. So if you want to increase the profit margin by increasing sales, you still need to bring down the costs, so that if the net income goes up, the profit margin may go up as well. But if you increase the sales and the net income doesn't change, the profit margin goes down. So that's how a company can make itself more efficient. It's by reducing costs, increasing the net income, and thus they become more profitable. Now the next ratio we need to consider is the debt to equity ratio. This ratio is important because if you're going to either invest in a company or trade its stock, you want to make sure that you stay away from those that can go bankrupt. Otherwise, you could lose your entire investment. Companies that may go bankrupt typically have a very high debt to equity ratio. The debt to equity ratio is equal to the total debt divided by the equity. And there's another one called the long-term debt to equity ratio. It's simply the long-term debt divided by the equity. And this is the shareholders' equity, which is the difference between the total assets of a company and its total liabilities. So let me give you an example of how to calculate this. So let's say a company's total assets is 900 million, and let's say that its total liabilities is 300 million, and its debt, not the long-term debt, but total debt, is 150 million. With this information, what is the debt to equity ratio? Well, the first thing we need to calculate is the shareholders' equity, which is the difference between the assets and the liabilities. The total assets is 900 million, the total liabilities is 300 million. So the shareholders' equity is the difference between the two, it's 600 million. Next, to calculate the debt to equity ratio, or we'll say the DE ratio, it's going to be the total debt, which is 150 million, and we're going to divide that by the shareholders' equity, which is 600 million. 150 divided by 600 is 0.25. So this is pretty good. The debt to equity ratio is relatively small. So that's a decent company. So that's how you can calculate the debt to equity ratio. But let's talk about which numbers are good, which ones are okay, and which ones are very bad. And this time, we're going to compare 4 different companies. Company A, B, C, and D. So let's start with company A. Let's say that this company has a debt to equity ratio of 0.03, and for company B it's going to be 0.47, company C 1.2, and for company D 9.6. Now for company A, the debt to equity ratio is very, very low. So this is very good. Now for company B, 0.47, that's okay. It's not bad. That's an okay company. For company C, the debt to equity ratio is 1.2. That's like, Now for company D, it's 9.6. This is very bad. The debt to equity ratio is high. That company might be going bankrupt. It's not a guarantee. They may turn around and fix the situation, but it doesn't look good for company D. So hopefully this gives you a good idea in terms of what values are good, what values are okay, and what values are very bad. Most companies will fall in this region. But if you see a company that has a debt to equity ratio of 0.10 or less, that means it's very good. You don't have to worry about them going out of business with debt anytime soon. Unless, of course, they're faking their numbers, which happens occasionally. But companies with a very high debt equity ratio, you need to be careful with that because there's a good chance they can go bankrupt anytime soon. So that's it for the debt to equity ratio. Now let's move on to liquidity ratios, such as the current ratio and the quick ratio. These ratios measure the ability of a company to pay off its short-term debt obligations. Now, unlike the price to sales ratio and the price to earnings ratio, you want the liquidity ratios to be high. A good company will have a low PS and low PE ratio, but it will have a high current ratio and a quick ratio. The current ratio is equal to the current assets divided by the current liabilities. The quick ratio is equal to the liquid assets divided by the current liabilities. Now, the liquid assets include cash, cash equivalents, accounts receivable, and marketable securities. You can also calculate the liquid assets by taking the current assets and subtracting them by any inventory and any prepaid expenses the company may have. So now let's focus on the current ratio. And let's use two companies to illustrate an example. So let's say for company A, the current assets are 400 million. And for company B, it's going to be the same, 400 million. Now let's say that the current liabilities for company A is 200 million. And for company B, it's 800 million. Now let's calculate the current ratio. So for company A, it's going to be the current assets divided by the current liabilities. 400 divided by 200 is 2. For company B, it's 400 divided by 800, which is 0.5. So note that company A has a high current ratio. This because it has more assets than liabilities, which is good. Company B has a low current ratio. This because its liabilities exceed its assets. So chances are it's going to have to borrow money to pay off those current liabilities. Thus, 0.5 is not a good number for the current ratio. So when analyzing a company, you want the current ratio to be 1 or higher. The higher it is, the better the company is at paying off its short-term debt obligations. So to review, a good company will have a current ratio that is greater than 1, and the same is true for the quick ratio. You want that to be greater than 1 as well. And when it's greater than 1, it means that the current assets exceed the current liabilities. In the case of the quick ratio, it means that the liquid assets exceed the current liabilities. If the current ratio or even the quick ratio, if it's less than 1, that's not a good sign. That means that the company has more liabilities than assets. So make sure you understand the concept behind the liquidity ratios. It measures the ability of a company to pay off its short-term debt obligations. So keep in mind, liquidity describes a company that is liquid is able to convert its assets into cash quickly, which is a good thing because some assets are not liquid. Think of a company with a power plant. You can't easily sell that. So that's not a liquid asset. A company that have marketable securities that they can easily sell at the market, that is a liquid asset. They could turn that into cash quickly. So companies with a lot of liquid assets, they can quickly pay off their debt if they need to. So that's it for this video. Hopefully it gave you some good metrics that you can consider when deciding if a company is undervalued or if a company is about to go bankrupt. So in order to determine valuation, you can look at the price to sales ratio, price to earnings ratio, and even the price to book ratio. In order to determine if a company might go bankrupt, you want to consider the debt to equity ratio, the current ratio, and the quick ratio. And to see how efficient a company is operating, consider its the profit margin for that company. The higher the profit margin is, the greater the ability of the company is to convert sales into net income. So keep in mind, a company that has a profit margin of 20% means that 20% of its sales is net income or earnings. The other 80% were used to cover expenses. So the higher the profit margin is, the more efficient that company is operating by keeping its costs down. So that's it for this video. Hopefully it gave you a good way into conducting your fundamental analysis of companies. And thanks for watching.